Hi, this is George Dagnino, and this is the final part of this series dealing with great. Now you have $100,000 to invest. What are your options? This is the final video. The objective of these videos was to show you and review some of the investment models I use in my work. In the previous videos from part 1 through part 5, I looked at the use of financial analysis to establish an investment portfolio, the use of sector surfer models presented in this video in this website, the use of moving averages as I discussed in my books, and how to set up the dual momentum portfolio, which is a very powerful technique. In this video, we are going to deal with macro strategy, which is the one I feel very close to it. What is the mindset of a macro strategist? Well, he believes the direction of growth of the economy drives earnings and drives stock prices. In fact, it drives all prices, interest rates, bond yields, commodities. He understands how market sectors react to different economic conditions, how some sectors are strong when the economy is strong and some sectors are weak when the economy is weak, and vice versa. All the information you need is in the price and how they behave relative to the market. The idea is to invest in choices that are stronger than the market. This is what this relative to the market means. The macro strategist has some very simple rules to recognize the direction of the economy, which I will show you next. But the direction of growth of the economy tells you if you should invest in cyclical or non-cyclical companies. Cyclical means that they perform well when the economy is strong, and this non-cyclical means that they perform well when the economy is weak. Strong companies relative to the S&P 500 are likely to remain strong due to products, cultures, and management. Here, this is a very, very important point. Companies like Microsoft, Apple, there are many, Home Depot, these are Disney. They are very strong companies because their management culture, because their product, their services, the way they deliver, it has a history, and this history projects in the future for many, many years. It's difficult, very difficult to destroy. This is a very, very important company, concept, and that's why, for instance, I always invest in the same limited number of stocks because there are very few but reliable, strong companies. The other concept is that bonds have a major role in reducing portfolio volatility when market risk rises. When I dealt with ETF models, even in my book, I run several models. That the use of ETFs, the bonds, is in case of a sharp decline in stock prices, always helps cushion the losses. In fact, in some cases, if one is aggressive, actually you can make money. So bonds have an important role in managing the portfolio. You don't have to be a famed economist to know what's happening to the economy. You need a very simple chart like this one. This is the growth of employees, good producing employees. And you can see, and the reason is in manufacturing is very sensitive to business, changing business trends. And as you can see, since 2011, there has been 3 minor business cycle, call it mini cycles. And this is when the economy slows down, and this is when the economy picks up. And then in 2018, the economy started slowing down. The investment strategy followed during the period of economic strength or strengthening is different from the kind of investments that you choose when the economy slows down. This is a crucial point. The other thing, and again here is Say's law in 1803, it's a famous economist. What they are saying is that production leads demand. So if manufacturing is weak, don't believe that the service sector, we are an economy 73%, yet is consumers. Yes, that is nice, but if the manufacturing slows down, you can rest assured that also the consumer sectors is going to slow down. And of course, the opposite comes here when the economy manufacturing strengthens. Now, again, since 2018, manufacturing has been weakening, and sometimes towards the end of 2019, already the statistics are beginning to appear that consumer spending is sort of weakening. So you cannot overcome this concept that if manufacturing is declining, the employment manufacturing is slowing down. Actually, this is a change over 12 months. You can rest assured the economy is in a slowdown period. And accordingly, you have to use the strategy that is the most appropriate during a period like this one, or like this one. The main concepts to implement a strategy is that you have to recognize that stocks have a superior performance than ETF. The ETF represents an average, but you can select out of an ETF the best performing stocks that outperform that particular ETF. High quality companies are likely to remain solid investment because of superior product, services, management, and culture. I mentioned this before. Dividends play a major role in the outperformance of these stocks. Again, see Jeremy Siegel books. There is tremendous amount of history showing that if you buy good companies that pay dividends for a long time and increase dividends for a long time, those are the best investment over the long term. Company paying dividends for a long time with conservative dividends payout ratio. This is important. This number can be, by the way, can be seen on Yahoo company statistics. They provide this payout ratio are the most attractive ones. The other thing is comparing stock performance to the S&P 500. In other words, the relative strength of the stock relative to the S&P 500 provides a reliable tool to determine whether the big players are buying or selling. I will show you how to recognize that next. On page 4 of the Peter Deck portfolio, which I edit and publish, I show the relative strength of, these are the Dow stocks, and there's the major ETFs. And what the experience has been, and this is why I say relative strength has a tremendous momentum. In other words, companies that have a strong product, earnings, dividends, remain strong, is that I flag the ones that have the best price volatility. In other words, they're least volatile. And the same thing I do with the ETFs. Again, the companies are always the same. I mean, forever I have Microsoft, I have Home Depot, Apple. It's always the same. Visa, I had for many years. Sometimes I don't use it, but Visa is one. Walmart. They're all good, sound companies. Here is the same thing. The dividends, low volatility, staples, utilities have been with a high relative strength because for 2 years the economy has been weakening. So always the same sectors have rising relative strength, and they are stronger than the market. So that's why I'm saying once the economy keeps going in one direction, always the same sectors show superior performance. This is how one should, I think, manage a portfolio. The portfolio is a dynamic thing, has to adapt to economic conditions. So it's like sitting here, and what you see is if the economy weakens, you have to increase non-cyclical stocks, that is defensive stocks, and decrease the cyclical stocks. On the other hand, if the economic weakens and instead on this side the economic strengthens, you have to do the opposite. You decrease the non-cyclical stocks and start increasing the cyclical ones. So, and as the business cycle changes, your portfolio composition changes and adapts to it. Bonds have a stabilizing effect on your portfolio. So if the economy strengthens, like here, obviously yields are likely to rise and bond prices to decline. So as the economy strengthens, you should reduce your bond holdings to 0, 20% of the portfolio. But if the economy weakens, instead you should protect your portfolio with an increase in bonds to 40, even 50% of the portfolio, because as the economy weakens, yields decline, bond prices rise, and therefore they cushion whatever risk there is in your portfolio. Which stocks I use to establish a portfolio and what kind of software is useful? Well, the software is freestockcharts.com, which, by the way, is a great software and can be used only, unfortunately, with Microsoft Explorer, not Edge. I will show you the page. What you do, in this software, you enter the symbol of ETF Noble. These are the dividend aristocrats. These are around 95 companies that are showing historically, for at least for 25 years, increase in dividends. They are superb companies. You scan the charts using a space tab, on your laptop, on your computer, and you run through the symbols. In the charts, I'm going to show you what charts are used to select the stocks based on what indicators. Very, very simple. By the way, I discussed in great detail this aspect in Investing Wisely. It's easier than you think. The objective now is how to find the stocks of good companies that the bias has been historically to outperform the market. But in order to do so, I really would like to show you a test that I made and the performance of a portfolio that I was published in the Peter Duck portfolio in May 18. Also, by the way, the same portfolio was also shown on page 119 or Investing Wisely. Now, in the portfolio, Visa is not included because data were not available in 1994. Some stocks have been sold from the model portfolio, the Peter Duck, or my publication, Peter Duck portfolio. I don't know what happened to them. But anyway, just to show you, the idea is to show you that some stocks, just leave them alone and they are an amazing performance. Let me show you. This is a portfolio that I had in May 13. My publication date was 5/13/2018, and these were the stocks that I selected. These are all great companies. This one is Constellation has had some trouble recently, but anyway, I didn't touch them. I didn't know the trouble they were going to get in. So anyway, I asked myself, what happened to those stocks? How did they do now in 2019? What is the performance of this very simple portfolio? Let me show you. What is the performance of that portfolio where each investment is equally weighted? Well, the S&P 500 investing $10,000 rose as of 10/2/2019 to $100,000 roughly. The buy and hold portfolio, those stocks, rose to 1,020,000. So the performance is 10 times better. I think this is incredible. But this gives you an idea. If you buy good companies paying good dividends, for rising dividends for a long time, they provide you with a great returns. Now, the problem is risk. The S&P 500 in the worst performer was lost 51%. The same thing, you lost 51% on that portfolio, and clearly when people lose 50% of their capital, don't feel comfortable. However, if you use a timing mechanism using the 200-day moving average, if you sell the stock, if it falls below the 200-day moving average at month end, this is crucial, at month end, then you sell it. If at month end a stock moves higher than the 200-day moving average, then you buy it back again. Always the same stocks. Then the maximum drawdown, the maximum loss is only 28%, but it's almost 50% lower than the buy and hold strategy. So this could have an advantage. But the point is, these stocks perform extremely well. This is the performance of the same portfolio. This is of those stocks, buy and hold. This is the performance with the timing mechanism using the 200-day moving average, and this is the S&P 500. Clearly, investing in stocks of good companies with rising dividends in general as a concept is the way I think investors should go. Okay, now the next step is to find the best performing stocks, and we choose those from the universe of companies paying growing dividends, and we use that using freestockcharts.com. Let me show you how. This is how you establish your page on freestockchart.com. And what you see here on this column, what you do, you enter, and they give you, here the instructions on how to enter the symbols of the companies that that are members of the ETF Nobel, NOBL, which is companies that call the dividend aristocrats because they are companies paying dividends and increasing dividends for the last at least 25 years. The page is divided in two sections. This is the price of the stock. This is the 50-day moving average, and this is the 200-day moving average. In the second part of the screen is the ratio between the price and the S&P 500 and SPY. So this is the green line. Then you add to that the 50-week moving average and the 200-day moving average. It's very simple to do it by using the settings, and the chart is done daily. Now you can use it weekly or monthly. You can this particular chart is on a daily basis. This is the chart of Cincinnati Financial, and again, what this chart is saying is saying, look, this company has been appreciating, looking at the green line, faster than the market for some time, at least for a year and a half. The trend is up, so that means that the price of Cincinnati Financials is rising faster than the market. What you have to pay attention to is when the time when the price is weak than the market, then slightly start appreciating faster than the market. This is crucial because that means that those analysts that pay a lot of time talking to the chairman of the board, to management, studying their financial situations, their plans, and so on, they know something, and so they start accumulating. And this is when you see that relative strength of the stock start going faster and faster. When this happens, you know something fundamental is changing in the companies. And sure enough, this fundamental change has a long way to go and is a very lasting effect. And this is Cincinnati Financial. Let's see another example now. This is the chart of Cintas. This is it. By the way, you can scroll through all this chart by hitting the space tab on your keyboard. It's very quickly, very efficient. You can go through 95 stocks maybe, and once you get accustomed to the charts, not more than 10 minutes. Again, this is the chart of Cintas daily, same period of time. This is the price, but I always focus on this part of the chart. Why? Because this, you see this inflection? This inflection here says, look, it's losing relative strength. The green line went sharply below the blue line. So someone is doing some selling and finds the stock not doing well. So it's time to pay attention to this. And sure enough, if you look at the price of the stock, for some time has not done much. Then suddenly the price is beginning to gain relative strength. So when you see this, you got to pay attention to this rising of the 50-day moving average and the green line, the daily, above the 200. The price here goes above the 200-day moving average. So something has happened, and this stock you should be paying attention to the future of the stock. And sure enough, the relative strength, they're going up, the price going up. That's exactly what you want to see. Of course, you will also find stocks that you should not buy. And this is CVX, Chevron. Here it is. And look at, when you look at this chart, you don't have to look at the price. Just look at the relative strength relative to the market. The Chevron has been weak for all the way down for years. Why? Because in a slow economy, energy stocks don't perform well in material stocks. So you can see the relative strength, the green line, the blue line, the red line, they're all coming down. So that tells you there is a big momentum in underperformance, and this is not the kind of stocks that you want to be in. This is the chart of NOC Northrop. Again, look at as I said, I always focus to the below, the graphs below. And when I see this has underperformed for all this period of 2018, it has underperformed, the 50, the daily, the 50, and the 200. But look suddenly what happens here. Sometimes in mid 2018, the relative strength start going up. The blue line, the 50 days start going up above the 200 days. All are moving higher. So that tells you here that someone knows something about this company. And sure enough, the stocks kept on going with appreciating faster than the market with fairly strong momentum. This is the chart of Procter & Gamble. Again, another, scrolling down the list. And this, of course, has to catch your attention because has been underperforming here. The relative strength is declining, but sure enough, at this point, it starts moving higher above the 200. And again, this is a classic pattern that tells you someone knows and someone has begun to accumulate this stock when this line started growing. And sure enough, this went up. One thing that I need to note, to point out, is always this analysis is good if the volatility of the stocks is low. What does that mean? It means that if the price doesn't go all over the map, there are companies whose prices moves like Procter & Gamble very within a very defined bound. So they have low volatility. This kind of analysis is particularly useful for this kind of stocks. And again, accumulation, rising relative strength, strong stock price. Well, there isn't much to say about this company. This company is Microsoft, and look at the relative strength. Look at the 200-day moving average. This company is an amazing company, and is a buy and hold, and it's a great investment. There's really nothing to say. You just the time to worry is not close. So just enjoy the run. Again, that's what I said. A good company, well-managed company with solid management outperforms the market for a long time and stay with the momentum. This is the chart of the financial sector, XLF. And again, here beginning in 2018, which by the way is when the economy started slowing down, the relative strength of this sector started coming down quite badly all across the board. This should not surprise those of us who believe that the financial sector is a good investment when the economy strengthens. Forget about yield curve and all that. When the economy improves and strengthens, then you will see that the relative strength of XLF starts slowly moving up and going above the red line. But as of this particular day, the trend is down in relative strength and is not the place to be. Well, another sector, the mining and metal sector, is XME, is similar to XLF. When the economy weakens, the sector loses in relative strength, and you can see underperforms the market quite badly. This is the price, of course, but this is the chart you have to focus on. When the economy will strengthen, will overheat, you will see these lines to start turning up and moving higher. But right now, that as of the day of this chart, this is not a good sector to be in because badly underperformed the market. This is the chart of Walmart. Again, here much weaker than the market, but here something happened with relative strength improving, and so that was telling that maybe the weakness in the price was probably going to be over. Relative strength rises above the 200, both the green and the 50-day. Then the 200-day start rising, and the price start moving up with relative strength rising. So that would tell you that this big major retailer has something going for it. This is the Peter Dack portfolio as of 9/19/2019. And again, the point I'm using this chart from stockchart.com to show that the S&P 500 is here. And what I'm trying to do is to choose stocks that perform better than the S&P 500. This is over 200-day. And that's where I would like to see all my investment. If they start underperforming, losing in relative strength, or performing worse than the market, they definitely are eliminated from the portfolio. And by the way, once they are sold, I never look back and say, oh my God, I should have kept it. No, I do my analysis every month, and you got to keep focused on what will happen in the future, not what you have done in the past. What is the bottom line? The bottom line is that you should make decisions, at least I try to do it, only at month end. Sell those investments which have a declining relative strength, because obviously someone who knows something and is selling heavily. Keep those investments with rising relative strength. Now, your portfolio should reflect the business cycle, and therefore usually what you do, you use the change in manufacturing employment or the ratio SPY to TLT, which I discussed in a previous video, to see if the economy is weakening or strengthening. Be careful if the SPY falls below its 200-day moving average at the end of the month, because it means that the market may be facing some high volatility. And above all, some final thoughts. Believe in the model you use. Finally, you chose the way to go. Believe in it. Don't try to override its message. If you chose that model because the back test that you have made or others have made shows great performance, do not try to override it. Otherwise, you destroy the message of the historical performance. In the long run, you will be sorry if you overwrite your model. Just stick with it. Well, I hope you found these 6 videos useful and instructive, and they gave you some ideas and about how to set up a portfolio using financial analysis, using sector surfer, using moving averages, using dual momentum, or using a macro strategy. Again, thank you very much for viewing these videos, and I'll see you very, very soon. This information is analyzed in detail in each issue of the Peter Duck Portfolios, and of course is discussed in great detail in my 3 books, Profiting in Bull or Bear Market, Easy Ways to Beat the Market with ETFs, and Investing Wisely. It is easier than you think. Again, thank you very much for listening, and I'll see you really soon.